Lime scooters have become omnipresent in the modern urban landscape. Now, the company is moving to capitalize on that visibility with a massive $1.8 billion valuation target on Wall Street. Formally registered as Neutron Holdings Inc., Lime is offering 6.68 million shares to the public. They are aiming for a price range between $24 and $26, trading under the ticker symbol LIME on the Nasdaq. This growth is reflected in their top-line revenue. In 2024, Lime brought in $686.6 million. By 2025, that number surged to nearly $900 million. However, Lime's official SEC registration statement shows that while revenue is climbing, net losses are actively widening. The filing reveals that a significant portion of this revenue growth isn't originating from Lime's own platform. Instead, it is structurally tied to the digital ecosystem of a primary competitor. This creates a central tension in the IPO.
Lime is positioning itself as a standalone market leader, but the underlying financial mechanics show a business deeply integrated into another company's infrastructure. Currently, any user with the Uber app can locate and rent a Lime scooter without ever downloading Lime's own software. It is a seamless customer acquisition funnel that puts Lime's hardware directly in front of Uber's massive user base. This integration is a primary driver of their scale. Last year, 14.3%. The results of these costs is visible in their net income. Despite the jump in revenue, Lime's losses nearly doubled in a single year, widening from $33.9 million to $59.3 million in 2025. This highlights the core challenge of the business model. In the platform economy, the company that owns the digital user interface extracts the market value, while the company managing the physical assets absorbs the operational risk. Uber is doubling down on this relationship by acting as an anchor investor in the IPO, with plans to inject $20 million into the company at the public offering price. Uber shares face a 2-year staggered lockup agreement. That $20 million is just a fraction of the $180.9 million Lime expects to raise. SEC filings mandate $115 million of these proceeds immediately pay down an outstanding senior secured term loan. Most of this public capital is being used to settle existing debt. For a business at this scale, using the majority of an IPO raise to pay off old loans suggests that the capital is supporting past operational costs rather than future expansion. As Lime makes its debut, investors are tasked with evaluating the sustainability of this specific risk profile. The central threat to the business is its reliance on a single partner. If Uber decides to deploy its own fleet or switches its app integration to a competitor, nearly 15% of Lime's revenue could disappear overnight. A $1.8 billion valuation currently relies on the continued cooperation of a distribution partner that has its own strategic interests to protect. This leaves investors with a choice at the $24 to $26 price range. Are they buying into a standalone transit leader, or are they funding the physical infrastructure for another company's app? Ultimately, Lime's IPO serves as a lesson in the modern economy. Owning the hardware on the street provides very little leverage if you don't own the customer on the screen.